bullshitting more than I usually bullshit because I literally have nothing to say, which is exciting. I'm excited for it.
Yeah, I'm glad you said that because I had exactly the same thought. And then you and I have talked about it a lot privately. Is like the whole point of like having a duo or whatever is like hopefully, like you said, you're in a mood, and hopefully the other person's not in a mood, so we can kind of carry each other a little bit. But it's awfully tough when we're both in a mood. So I'm gonna pretend like I'm not.
I appreciate it.
Shout out to the comment sections to Goblin Town. See all the usual suspects in there, and even old Adam Butler's in there with the cheers. Happy Friday, Adam. And make sure you turn into Resolve Riffs right after we get done here. They should have a humdinger today, so to speak.
Yeah, Jem Carson on this afternoon, if I'm not mistaken.
Yep. And then we need to come up with a good, I like your Goblin Town, but I think we need something better for our comment section. What is it?
Well, the YouTube comments is definitely a whole Goblin Town situation. The live comments are friends and family.
Great. Yeah, exactly. Yeah. So is that part of the pirate ship? Is that the Corsairs, the Brigadiers, the I don't know. You and I today are malcontents, so maybe that's it. I don't know.
Yeah, I feel like there definitely needs to be a good name. I feel like every podcast ends up coming up with a good name for their listeners, like the Nation or whatever. Got to come up with something. We're not clever enough. You are. I'm not. I'll wait for you to come up with something.
Yeah, you want like the beehive, the Bayhive, and like you want now.
Yeah, exactly.
This is like the most solipsistic conversation that we've ever had.
Is this better? Is this better or worse than talking about animal crackers the way we did last week?
No, this feels like we're talking about ourselves in the third person. Like, what do we call the people that listen? What do we call the? It's ridiculous. Anyway, before we get like to mutineers is a good one, but it also reminds me of the Musketeers. So that always throws me off. But I do like the mutineers. Do you just for everybody's edification that's watching us live here, you are in an undisclosed location. It looks like you're now an art dealer, right? You're in an art gallery.
Yeah, I guess so. I guess so. I have left the Caribbean. I am no longer in Grand Cayman, unfortunately. I am in an undisclosed location in Massachusetts somewhere, and we'll be here for the rest of the summer. Currently living in a hobbit hole, I guess. The house that my wife rented for us for the summer is from like 1850 and has ceilings that are maybe 6.5 feet tall. And for listeners who don't know, I'm 6'4". So it is like I'm banging my head everywhere. There's no light. I'm literally sitting in front of the one window in the house. I'm delighted.
Just
delighted.
In the comments, how about Booty Crew? That one might stick accidentally. Oh my god, I'm crying. That was so good. But are you excited to be? I saw on your Twitter too. That's so funny. It's like we have both like private discussions in the Twitter. It's like I can't remember which is which, but it looked like you posted pictures of your the new gym you found. At least you have a better gym in Massachusetts than you had in Cayman, or?
Oh, the Cayman gym was a real gem, though. It was like old storage unit that had been converted into a gym, and it was like 3 of us at 5 a.m. just clanging and banging these old rusty weights. This is like the most classic Boston Southie type gym, South Shore gym, where it's like all policemen and firefighters and like blue collar workers who look and sound the most Massachusetts you possibly could. So just think of like a bunch of Mark Wahlbergs running around, I guess.
Well, yeah, but it seems like you just said with your both gyms, you strike me as somebody that loves that like old school power lifter, rusted plates, like just like grunted out, yell and scream, throw the weights around kind of gym.
Yeah, I love that because I'm the guy in the corner doing yoga while everyone else is doing that. I really like to stand out as much as I can.
Guys, I got to stretch out. I don't want to pull a hammy.
Yeah, exactly. Exactly. 45 minutes of yoga, 1 deadlift. I'm out. All right, Jack, let's get him in and save the show.
Yeah.
No, the show is good so far. I just want to say that when I title things, I just make it clickable. Clickability is number 1, and then relevance to the topics is number 2. So I knew that you guys didn't want to talk about inflation, but today's a huge day. Markets are crashing. So when the ducks are quacking, you got to feed them. It's like when if you're the CEO of a stock and your company goes from $10 to $200 and it's like trading at 15 times like 20-30 revenue, you got to issue some stock. Like the crowd wants it. You got to give the crowd what they want and take advantage of it. But I know that you guys don't want to talk about inflation at all. So I may sneak a question about it later, but I'll start one that's actually quite derivatives focused, which is Corey. You said that your ceiling is 6'5" and you're 6'4". I couldn't help but think of the story of the 6 foot tall man who drowned while walking across a river that was on average 5 feet tall. But that also made me think that this year to date, that man might actually have made it across the banks to the other side, because despite the sell-off that we've seen in the huge realized volatility in single stocks, as well as the dismal performance on the index level, you haven't had sort of down 4% days. And as such, I guess you could say like the realized skew in the S&P 500 has been small, and therefore the VIX, despite the fact that we have all this macro doomland, of which I'm definitely like a contributor to that for sure. The VIX is only at what? I mean, it was at like 24 yesterday. Now it's at 27, 28. So how would we think about whether volatility risk premium is appropriately priced? And I mean, to an observer, it would seem that perhaps even the VIX is lower than realized volatility, but is that not true? So yeah.
How much of this question came from the fact that you interviewed Ben Eifert on Monday? I'm not answering this till I'm sitting here going, okay, I know who he was interviewing earlier this week.
It's the same thing. Yeah, last week he did the same last week too. Yeah, it was based on who he interviewed, and I'm figuring out Jack's tricks. It's like, as you just nailed, it's who he interviewed that week for his shows, and then also I think a lot of the Blockworks newsletter also gets filtered through for a lot of the questions. So we're on to you, Jack. But that was a 10-part question. But Corey, you can go ahead and start to parse it.
I think he's asking, how do you measure if implied vols are fair or not fair or cheap or expensive? Is that Jack? Did I get that right? Because I think I only tracked half that question. I got too focused on the man drowning in the river.
Exactly.
Yes. So I'd say the first question is just about process. It's how would you go about establishing whether implied volatility is rich, cheap, or fair value? And the second one is about, when you look at it now, is it the case that, I mean, it's easy to say, oh, VIX at 23, well, we have this huge sell-off. What's going on? Volatility is underpriced. But apply the framework that you just talked about for the first part of my question to what we're seeing now. And yeah.
Yeah, I think the way I would tackle this, and I wish we had Darren Johnson here, because I think he'd give a great answer. If you don't follow him on Twitter, definitely give him a follow. He's incredibly thoughtful on thinking about pricing vols, but I think there's a couple of ways you can tackle this. I think the initial way a lot of people tackle it is just looking at this stuff naively on a historical basis. So you might look at, say, where is implied vol priced, or where is skew priced on a historical basis, and then you would make adjustments to that for certain event risks that are coming up. So you might want to price in the fact that we have an FOMC meeting next week, which might dramatically change implied vol over the next month, but may have less of an impact depending on your view on long dated implied vols. And then you could sort of look at the way I would then start to look at it is try to think about some positioning and say, what impact do I think positioning has on whether people have demand or providing demand or excess supply to this trade? And then do I think that's having a positive or negative impact on implied vol? So one of the things we've seen, and you tend to see historically after significant sell-offs, is there's demand on the put side. And so you tend to see elevated skew. You tend to see implied vols stay elevated far longer and far higher than they necessarily should. Selling vol tends to be pretty good in those environments, because when markets are well protected, I'm a believer it's harder for them to actually sell off. And so it's harder for that, the price of that premium to get realized in risk. So I think there's a number of different angles you need to tackle it from, but there's no single one answer as to say whether markets are over or underpriced, whether you're talking about equities or implied vol. There's no single answer to that.
So there's no single answer. There are several things you touched on there that are interesting, especially most people, I think, I'm thinking where Jack was asking the question, are most traders are going to create their own theos or theoretical values of where they think vol should be priced. So it's not necessarily just looking at screens for VIX for implied and then looking at the historical basis. They're going to create up their own theoretical models for predicting where they think vol should be, and then they're pricing based on that and whether they're going long or short volatility. So it's not necessarily what you would see just by looking at a screen with publicly available information. The other thing that you were hinting at too is, if you follow like Darren Johnson, is like, are we talking close to close? Are we talking open to close? You know, are we talking overnight? Like, you have to also build your realized models or look at realized over different time horizons and not necessarily just close to close. The other thing is like, and then if you're buying or selling vol, then you got to worry about what strikes you're buying or selling, right? And like you were saying, how is the vol surface, changing? What does skew look like? You have to factor in all those models for what's overpriced or underpriced based on what you're buying. And then like an example is, I think this, when you have, VIX is a terrible proxy, but when it's between like 25 and 35, like we've been seeing for a while, I think it's one of the tougher environments to either be long vol or short vol, or, at that relative value trade becomes exceedingly difficult in the kind of this range. And even in price now, like 2017, I think we talked about before on the show, even though vol was in, VIX was in single digits, that was one of the best times to be shorting volatility. So it's really, how does that delta open up? And it's not just like, that delta is not static between implied and historical. You're going to be looking for the fatter parts of that delta when it's expanding versus contracting. So there's a lot of issues there. But then to get 30,000 foot view and then maybe a little trite or cliched is like, what always bothers me is when people talk about vol being overpriced or underpriced. And there's no way of knowing that it's ever in hindsight bias, right? Like if we're going into, 2019, people are going to say, vol is, overpriced because we didn't see a pop. And then in 2020, it was underpriced because that pop in vol. You only see in hindsight whether vol was accurately priced, overpriced, or underpriced. It's really hard knowing in a current environment on a look forward basis if vol is technically overpriced or underpriced. One, it depends obviously on your trading strategy, but more importantly, we find out exactly if the implied pricing was accurate for what we experienced in real life.
I really have to call out this comment saying "nice glasses there, sizzle chest." That is probably the best comment we've ever received. I've ever received. Thank you, King Cardano.
You are going low buttons today, huh?
Oh, listen, man, as I said, I'm having a day. I'm having a day, man. And buttons were just too much for me. We'll figure it out eventually. We'll figure it out. So, Jack, I think that, I don't know if we got your full answer there. I mean, I think historically a lot of people would naively break it down into what type of market regime are we in? How is that, you can sort of forecast going forward from there, given on where VIX is, where skew is, different properties of the surface. Is it a better or worse time historically, naively, to extrapolate should you be long or short vol? But I think you really have to take into account the different event risks that are getting priced into the vol surface, and try to see whether you think that event is over or underpriced ultimately.
Right. So like you're saying, it's more the individual trader's theoretical values than necessarily looking at VIX and realized. Is that like,
right? Yes.
Jack, did you have like further, like, did we totally miss your question, or like you have further?
No. So when you say theoretical values of the put or of implied volatility?
They're modeling implied volatility.
Okay.
Yeah. I mean, I think naively, the answer I always go back to is the market's efficient. And so these are all the right prices. If they were obviously the wrong prices, they wouldn't trade there. So let's just start with the null hypothesis, the market's efficient. And then we have to have a good reason to say why we believe some of these implied volatilities are not necessarily the right prices. So as an example, I know people who look to take the other side of flow trades because they think big rebalances like JP Morgan, and not talking about how they impact the underlying equity market, but how they actually impact the vol surface when they're placing these big trades. You have people try to say that that's going to ultimately drive, for example, the puts too high, the calls too low. Taking the opposite side of that trade may give you implied vol at elevated or cheap levels, and then you just have to sort of appropriately delta hedge that out. Those are very explicit trades for that contract as to whether it's cheap or expensive. To just say, is a forward variance swap cheap or expensive right now is a hard thing to try to explicitly say without some sort of model view.
And then, sorry, Jack, before we jump in there, I want to I want to pull out something you said, Corey, though, that's tangential. Is you just, when you're talking about efficient market hypothesis, not that you needed me to defend you, but like when you start talking about this stuff on Twitter, you bring it up. I think people start to rage and think that you're all about EMH. But to clarify, and correct me if I'm wrong, you're saying that like you have to use the basis of EMH is correct. And you have to say, okay, here's where I think the mispricings are or where it's out of line. Is like, that's what you're saying is like the heuristic is markets are efficient. Therefore, if you think you have an edge, you better be able to clearly define that edge because otherwise your base case should be markets are efficient, not that you believe markets are efficient, right?
Yeah,
There's a very
I think
distinct nuance there.
It's sort of like the scientific method. Your null hypothesis is
Yeah.
that the market is efficient, and you're trying to find evidence that suggests from a probabilistic standpoint it's not. And I think anyone who's an active manager doesn't believe the market's efficient, but I think if you've been in this game long enough, you should be humble enough to recognize it is pretty darn efficient in a lot of different ways. And even where it's not efficient, there's a tremendous amount of randomness. And so I don't think it's harmful to start from the baseline assumption that markets are efficient and then try to find the obvious cases where they're not necessarily efficient.
Yeah, that all answered my question. I mean, it's a question we could talk about for 5 hours. But I guess let's move on to a related question, which is let's take the situation we've had year to date where you've had continuous selling pressure on the S&P 500, but the realized volatility on a day-to-day basis has not been extreme, even though in single stocks it has. Let's take that to an extreme and say from June 13th, Monday, from June 13th, 2022 to June 13th, 2023. So for an entire year, the S&P 500 sells off 40 basis points every single day. What if you have a bucket of sort of tail risk or convexity alternative strategies, let's say, what in that bucket is going to perform well and what is not going to perform well and why?
Well, I may have missed the last part of the question, but like we kind of talked about this a little bit on the last time, and it's implied is or Vega or VIX is the forward 30-day variance expectation, right? And so like you're Jack saying, you can grind down like we've seen honestly for the first 4 or 5 months of this year, where you're just grinding down lower than the implied expectation, and that can go on for a very long time, like you're saying, if it grinds down 40 bips a day. The issue is eventually implied is going to come down around that 40 bips level. And all you need is a day of like 50 bips, or obviously more you depreciate, to see a pop in volatility. So that's the mathematical nature of like, they're going to be declining together over time. And eventually they become in line. And all you need is a pop in realized over implied for that to reestablish itself. But it can happen for long stretches of time where if the market's implying 1% daily moves and you're grinding down at 40 bips a day, then everybody's going to kind of get screwed there. Except for I think the second part of your question, I was sorry, I got distracted. Was what would do well in that environment? Corey, was that the question?
Yeah, I think he's saying if you have a basket of convex hedges, what's going to do well in a long grind down? Jack, just to confirm, that's what you're asking?
Yes.
Questions are getting longer and longer, Jack, and
yeah. Well, so part of that,
Jason has ADHD, and I'm just sleepy.
two things I'll talk about. One, as always, this is not investment advice, but the things that have worked so far this year fairly well, and given the environment is very similar to what Jack was describing, if we were talking about if it went into next year at just 40 bips a day, is if you're long gamma and you're scalping on a daily basis, that has done fairly well so far this year. But that's because it's the environment that we're in is a good environment for being long gamma and scalping those positions on a daily basis. The other one that's even worked, and I think you're kind of hinting at this, Jack, but maybe not, is dispersion trading has been working fairly well this year too. Short index, long single names, because as you're saying, the indexes are grinding down, but we're seeing a lot of vol on the single names. So maybe that's one. Those are two specific answers to your question. But once again, if you start seeing an environment where Vega picks back up, both of those other trades could get hurt. So it's not so simple. But in that very specific instance, restriking or gamma scalping on a daily basis is a good way to kind of take advantage of that if you have convex trades. And then the other one is that dispersion trade's been working, and it's going to work until it doesn't work.
Yeah, I think the way I would think about this is convexity is going to be heavily dependent on the price you pay.
Yeah.
Right. And one of the things that you find is sort of holding everything else equal, the more path dependent your hedge, the more convex it should be, because the probability of that single path dependency occurring, it should be low enough that that hedge should be priced much lower in the market. So just as a really simple example, saying I want a put option on the S&P that has a strike 20% below the current level of the S&P is going to be more expensive than saying I want that same thing conditional on rates also being up 30 basis points, right? By making the option conditional, you are effectively reducing the number of paths, future potential paths of which you will accrue value, and therefore the price should be cheaper. And so if that path occurs, you should have greater convexity. So what you really need when you think about trying to find convexity is how path specific can I afford to be, and how much is the market pricing that path? And again, post March 2020, there is significant demand for just sort of naive hedges like being long puts in the S&P 500 in that sort of 3-month area. And because of that, that premium is much higher. And so the potential convexity is much lower. I think when you're talking about long grinds down where you're not going to get much repricing of risk in options, you're not really getting paid for the vega. You really should, I think sort of historically, the evidence would suggest you're potentially better off with put spreads. Again, not advice, but if you're not getting paid, if you're buying the vega and you're not going to benefit from the vega, you probably want to neutralize some of that vega and just get the benefit of the delta side of it. But Jason, I know you and I have had many conversations about puts versus put spreads and when they're appropriate and when they're not. I have different opinions there, but again, I think for people trying to maximize convexity, I see people dive into the data first, and I think it always makes sense to take a step back and just think theoretically, what will maximize convexity? Well, what should maximize convexity is choosing very specific paths that we want to hedge. And I think when you're a portfolio manager and thinking about tail hedges, you can think, I just want the tail hedge that's the hero trade, or you can think about, I want the tail hedge that really protects my particular portfolio. And if you think much more specifically about your particular portfolio and where the real path dependencies are for catastrophic blowup, you might be able to identify cheaper hedges for those scenarios than just broad market hedges that a lot more people are likely to buy.
Yeah, and as you and I talk about a lot privately, is the idea with put spreads. To me, like we're talking about null hypothesis either with efficient markets, is like the null hypothesis is why not just buy a put? You know, as soon as you start getting fancier structures or layering in structures and paying more commissions and then also having a short ball leg, you're starting to complicate it, right? And so the null hypothesis is just buying the put, and then you can go to put spreads and go to put ratio back spreads too. But then once again, the question is, why are you selling that one put to make up for that pricing, right? Are you better off just maybe buying? And then I want to touch on what you also said that I think is fascinating is that, you know, the convexity might be lower because of skew, but like you could still get convexity there. Like previously, if skew's flat, like at 2019, and you may be able to get, you know, a 10 to 20x payout on a negative 20% put. And now because the pricing's higher, you may only get 3 to 5x convexity out of it, but you're still getting convexity there. But now it's also a relative value, right? We have to think about what are we actually hedging against, right? And if the equity part of your book is what you're hedging against, so now you're toggling that exposure to make up for whatever attachment point you're trying to make sure you're truncating is like, now you may need to pay up more for that. So then now you're going to get burned on the other side on your theta bleed if you need to buy more options because the convexity is quite not there. And like we were talking about last time, you're almost getting into almost delta -1 instruments here with like the convexity is not quite, not convexity to it. It's much more linear. And at the same time, so the way we always think about it is like this triumvirate of carry, convexity, and certainty. And you can't get all three.
I gotta pause you there. You can't just say triangle.
Yeah.
You can't just, you draw a triangle in the air and you say this triumvirate.
No, fair. Just think of something
that's
else.
the most classic Jason Buck. Sorry, I love it. I love it so much. I didn't mean to cut you off, but I had to point that out.
So you're trying to think this. So you have this three-way. Are you happy? Between carry, convexity, and certainty. And so you can't get all three. Like you have to pick and choose one or two. And that's what you're saying now is like, okay, you don't have the convexity. So you might want more certainty with just buying puts or maybe some put spreads. But now you're worried about carry, right? So that's why you're moving to spreads. So like you have to like think about those three things. Those are the trade-offs you have in mind when you're trying to structure anything. And then this was what makes it difficult in this environment. If you are protecting against equity beta, it's really hard to have just a fixed spend on puts when you're protecting equity beta in an environment like this when skew is higher, because you're not really going to have that convexity. You need to provide as much protection as you would like, and your bleed's going to be even higher, and you might just be burning premium at the end of the day, because it's also like you were saying, like looking at the vol surface too, is like I have to pick my spots within the vol surface. But if I'm just rolling structures on a fixed spend, it makes it exceedingly difficult in an environment like this.